Good evening, marhaba, and a very warm welcome to everyone. Wishing you all a very happy new year and a compliant 2025. Thank you all for taking out time and attending today's session. I have with me my colleagues Karishma, Kushal, and Ashish, who would be taking you all through the intricacies of today's topic Gear Up for 2025, the MICS way. Karishma, can we have the next slide to let people know why we are calling it the MICS way? And the reason why we are calling it the MICS way is because 2025 looks to us like the most intensive compliance season for UAE. And therefore, today we are here to talk to you about what this most intensive compliance season going to bring for all of us. But before we start, what I want you all to do is to enter in the chat box what, according to you all, was or would be the most crucial time in UAE for corporate tax. Was it December 2024 or will it be next September 2025 where most of the return filings will be due? Can I have your answers in the chat box, please? Okay, most of y'all feel that September will be a crucial time for UAE. September 2025 will be the crucial time for UAE. Now, we will have it all figured by the end of this webinar. But coming back to the topic of compliance, what everyone is really looking forward to is for preparing towards the corporate tax return of income, which in itself also includes the transfer pricing disclosure form. And to warn you all, both these set of documents to be prepared and filed are very data heavy in terms of certain conditions to be made, certain reliefs to be claimed, and it would need a comprehensive planning to be involved. And now, this again brings us to the question, do we have time to make certain decisions now? To answer this question, we have hosted today's webinar where we'll elaborately discuss on what was supposed to be done by year end, the statutory deadlines which have already passed, and for what we have time till return filing. Before I hand it over to Kushal, please feel free to drop your questions, comments in the chat box, and we will either pick them up during the course of the presentation or definitely towards the end of the webinar. With this, handing over to you, Kushal.
Thanks a lot, Kinjal, for such a great welcome to everyone. And Happy New Year to everyone from my side also. Before starting everything, I just want to clarify that everything that we are saying in this webinar will relate to the tax period from Jan to December only. So if anyone have some certain different financial year, so they have to adjust that accordingly. This webinar is for the people who have Jan to December as a financial year, but the applicability will remain same. Karishma, can we start with next slide? So registration. So according to me on and according to everyone, the UAE corporate tax law applicability to everyone will start with registrations and it ends with tax return filings. So why registrations? So registrations will be applicable to every taxable person, whether they have losses, whether they are not operating, so anything else. So registration was compulsory for everyone. And in last year, on March 2024, the FT has issued some guidelines in which I think there's some issue in presenting the screen. Yeah.
It's visible, yeah.
So registration due dates were issued by FTA in March 2024, and in which they have guided some due dates for tax registrations. And if you missed those registrations, the fine was 10,000 dirhams per entity. So what to do now? So as we have closed the financial year and most of the deadlines are already passed, so as of now, what we can do, we can just check our company database on everything and every document that all entities are registered, whether it's a free zone entity, whether it's a loss making entity, whether it's a non-operating entity, all entities have to compulsory register. But and if you find any entity which is not registered, then apply for registrations immediately. There are chances that you may get the fines. So for those fines, you have the option to file for the reconsideration to waive that penalty. This was the thing what is already done. Now, for the entities which are registered in any foreign country but are operated from UAE. So for say if an entity which is registered in USA or Cayman or everything, but the management of that company is based out of UAE, so that entity will be considered as the tax resident entity for UAE. And for those entities, the due dates for registration is 3 months from end of the financial year. And if you are closing your financial year by 31st of December, the due date for those entities will be 31st March of 2025. So what you have to do for those entities, just do an analysis that if is the effective management of these entities in UAE, and if that's in UAE, just go for the registration. Then for natural persons taxability will arise only when there is will arise only when you have crossed the revenue of 1 million dirhams. So due dates for those also will be 3 months from 31st December 2024, which is 31st March 2025. And this is for the entities which are already there, which are already being operated, whether registration done or not. But for the entities which are newly incorporating, so for going forward, you have to check once you have incorporated the entity, just register within 3 months. So registration will be mandatory, as registration will be mandatory. So we advise register as soon as you can, so that you don't have to pay the penalty of 10,000 dirhams. And now registration is done. Entity has told the FTA that we are the taxable person and we need to file, we need to pay the taxes on the basis of profits and all. Now, after registration, the another compliance starts, which is return filing. Return filing is something in which we will show the Ministry of Finance or the authorities that this was our incomes, this was our expenses, this we are in profits, we want to choose for any option, what are the tax liabilities, we have to submit any documents. In this form, we will submit everything. So now as the financial year is closed, the tax period is closed, we will start with preparing for the financial year, preparing for the return filing. And the return filing, the basic details that we have to submit is what is our incomes and what are our expenses. For that, we have to maintain the books and accounts. So maintaining books and accounts will be crucial for every entity in UAE, as they have to submit the returns and they have to upload the financial statement also. And by financial statements, I mean your profit and loss account, your balance sheet, your ledgers, and everything that you have to maintain. And once you have your financials with you, then in tax return filing, there are certain options that we have to opt, like small business really. There are certain exemption options and everything, which comes with their own pros and cons that we will discuss in detail later. And once you have opted for, like you have analyzed that you want to go with this option, or you don't want to go with that option, then the next part comes mock tax computation. So mock tax computation means you just estimate your tax liability on basis of your figures that you are about to close, or that you want to close, or that are closed. On the basis of that, you just go through a mock computation and estimate the tax liability for a good provisioning, financial planning, and everything. Once you have your figure in your hand, then go with the information gathering. By information gathering, I mean collect the information that is needed, and collect all the information that is needed to be file the returns, and collect all the documents that are there needed to be uploaded while filing the returns. Once you have the data, once you have the figures, once you have the all the documents, then the final step is filing the tax return. In tax return, there can be two components. First is transfer pricing documents that will be covered by my friend Ashish later in this webinar. And another thing is the all the details about your income and expenses that you have to file in your tax return. Now, in my while presenting this slide, I just covered one thing, that you have to analyze certain options that are available there in your that are available to you, so that you can just plan your taxes. You can plan your taxes. There are certain exemption to certain entities. So Karishma, can we have the next slide so that we can cover all the elections that we have there? Okay. So qualifying free zone person. This is the different for say it if you account this on single basis or alone basis. This is a different law that we have for qualifying free zone person. And by qualifying free zone person, just giving the brief, I mean a free zone entity satisfying all the conditions to be a qualifying free zone person will be a qualifying free zone person. Not all free zone persons are qualifying free zone persons. You have to check whether you are satisfying all the conditions or not. So all the free zone entity or for the free zone entity owners, managers there, just check if you are qualifying all the conditions or not. Once you are satisfying all the conditions, then this is not compulsion that you have to choose for this option only. You have the option that you want to go for qualifying prison person or you want to go for your normal taxable rates. And this option is the significant area that we have to check. This is the critical thing that we have to check, because qualifying prison options comes with its own pros and cons. And on pro side, there is only one pro, that there will be 0% tax rate on your qualifying income. But on con side, if you can see that there are certain options, there are certain reliefs that we will discuss, like small business, tax grouping, and every other relief that you can't opt, because you can't have speed on both of your hands. If you are choosing for 0% taxes, you can't have another reliefs. Then in cases like if you have qualifying income and you have non-qualifying income also, then your non-qualifying income will be taxed at your non-qualifying incomes will be taxed at 9% without any normal deduction limit of 375,000 dirhams. Then to satisfy all the conditions, for say there is a critical condition of substance that you have to just satisfy, transfer pricing, auditing, that you have to do. So these compliances have their own cost. For substance, you may have to rent a you may have to rent office, you may have to hire employees if you are running your business on your own basis. But to satisfy substance, you may have to incur certain expenses. So just before going with the return, that if we want to be a qualifying prison person or we want to not be a we want to tax at normal tax rates, just check that our pros should be higher than cons. The cost of tax savings should be more than the cost of compliances that we have to make. Now, what if we don't satisfy any condition, or we opt to be taxed at standard rates? Then forget this relief for next 5 years. If you opted to tax at standard rates, not to be at a qualifying prison person level, then you have to pay taxes at for next 5 years. You can't opt qualifying prison person. This was the one of the major part that everyone have to cover. Now there is another option called tax grouping option, in which, like, if you are a group of certain entities, then authorities have given you option. You can treat all the entities as one taxable person, but for that also there are certain conditions that we have to satisfy. One of the major condition is that the holding company should own more than 95% in each entity or each subsidiary, directly or indirectly, that they can hold. And for tax grouping, tax grouping option also comes with their own pros and cons. They have their own benefits and losses. As if you are a tax group, then you can't. If you are owner of a tax group, then you will get the basic exemption limit of 375,000 dirhams. You will get only once, irrespective of number of entities in your group. For say, just giving an example, you have 10 entities in a tax group, and for the whole all the 10 entities, you will get 375,000 dirhams of basic exemption limit for all 10 entities if you are not having a tax group. But if you form a tax group, then you will get only single 375,000 limit while forming while you will get only single 375,000 limit if you have a tax group. There are certain pros of being forming a tax group. One is that you have to file single tax return. You don't have to file multiple tax return for all the members. You just have to file single tax return for whole tax group. Another is that, for say, if your one entity is in losses and another is in profits, once you club the financials, like you form the tax group, losses of one entity will be set it off from the profits of another entity, which may help in reducing the tax liability. And the compliance burden, of course, you have to file single return. You have, so that's why compliance burden will also reduce. But cons is that, first, this is limited only to subsidiaries or parent companies. Another, you may have to prepare separate consolidated financial statements for tax group itself. And another is that already discussed, you will get only single exemption limit. So just before forming the tax group, just go through these all pros and cons, that whether you want to form the tax group or not. And now, as we have closed the financial year and we are in new financial year, so if you have any plan, you had any plan that you want to form the tax group for 2024, then sorry, but you will not be able to form the tax group, as the due date for application for the tax group was, and the last date of the financial year will be the due date to form the tax group. For say, for 2024, you can't apply to form the tax group, but 2025, you have time till 31st December. Just analyze that you are satisfying, like the benefits, the pros are in favor of you. Just analyze everything and you can apply to form the tax group. But all the conditions that are needed to form the tax group, all the conditions that are there should be complied throughout the year, should be satisfied throughout the year. For say, if you are doing any structural changes in 2025, then those structural changes will not help you in satisfying the condition for 2025. That can help you in 2026, as we have already passed 15 days of the this tax period, and we may not, like, if you are doing structural changes now, then we may not satisfy the conditions for 2025, as we are not doing it throughout the year. These two are the main options or main critical aspects that can change the tax liability from zero to millions. Also, these two are the options that you have to check, like whether, because these two have a greater impact on your tax liability or tax figure that you have to pay. But after these options also, there are certain options, certain reliefs that are available to us or available to taxpayers on basis of their elections while filing their tax return. First is realization basis. So this option is available to all the assets that are being fair valued, all the assets that are being fair valued. And this option gives us a relief that you have the option that you can tax those incomes on realization, on actual realization only. So this is the option that you have to choose. You have to analyze whether your investments are expected to make profits. If all the investments are expected to make profits, then go for this option. If not, don't choose that option, because losses will also give us the relief from tax losses. So just check that. Another are transition rules. So in transitional rules, we have the option that we can revalue our qualifying immovable financials or intangible assets on initial corporate tax date. Just check that you have any asset falling in this category, and you have any option that you can revalue those assets to on the date of your first tax period. You can go for this relief. And then comes small business relief. So if you have any entity which have revenue below 3 million dirhams, then you can apply for this relief. What are the benefits of this relief? You will not have to pay any taxes irrespective of your revenue. For say you have revenue of 2.5 million dirhams and you have net profits of 2 million dirhams, then and also you don't have to pay any taxes because you have opted for small business relief. Just there are the major cons of this particular relief is that you can't carry forward your losses. So just check if you have entity which is satisfying the conditions of being in small business relief, but that entity is in losses, then you can't carry forward these losses, then you should not opt for small business relief. Then there are certain exemptions for qualifying group, like if you have any transfers within qualifying group, and by qualifying group I mean a parent entity holding at least 75% in each subsidiary, then directly or indirectly, then all the entities will be under qualifying group. So all the assets will be transferred at cost value, and election, you have to make an election. So for say if there is any transfer between qualifying group for any asset, So city law gives you an option that you can show that transfer at cost, your acquisition cost or historical cost basis only. You don't have to show at market value or the transaction value that you have made. But all these major of these election like realization basis and qualifying group transfers will be irrevocable transaction. Once you made this in your first tax return, you can't reverse all these options in your later returns. And then there is an exemption called PE exemption. So for any UAE entity, if they have any branch or any business outside UAE, business by business, I do not mean a new another company, but for say a business or a branch and everything, then you can go for a PE exemption. And in this permanent establishment exemption, you don't have to count any income and losses from that branch. You just have to pay taxes only for UAE entities. So all these elections that we have covered, just check whether any election is applicable to you. If yes, just check whether opting for that election will be beneficial for you. And if that is beneficial, just go for opting the relief. And once you have just opted to relief, you may have to provide certain documents that you may have to provide the certain documents that I have this proof that I want to opt for this particular relief. Then you can apply for that relief. This was all about elections. So we have maintained our books and accounts. We analyzed that we want to opt for any relief or not. Or now comes the second last part, which is tax computation. So a tax computation, mock tax computation will be the for say preparation part to file the tax return. In tax computation, based on our financial figure, based on every election that we have made, we should go for a tax computation before finalizing our books. And by finalizing our books, I mean auditing your books or closing our books. We should go for a tax computation. And why tax computation? Because it will help you in accurately estimating the tax liability. For say if you have any error or if you have any adjustment that is required from tax angle in your books, then you can plan your taxes effectively, like for say if you can plan your taxes, and by planning your taxes you have the option to save cash or tax payments also, and you will be compliance ready. And for this tax computation, MICS have launched their new tool called tax computation tool. So you can scan if you want to visit, or if you want to have a check at the R tax computation tool, just scan the QR code showing in the screen and you will be directed to our tax computation tool. In our tax computation tool in a tax computation tool, you can just that tool will give you a rough idea what will be your tax liability, then you can just check this tool. And now we have complete estimated the tax liability, and now comes the final part, which is of filing the tax return. Before filing the tax return, what information we have to gather, what type of documents we need to file the returns, that we have to check. And Karishma, can we have next slide, please? Thank you. So documents and information that will be required for filing the tax return will be: first, your financial statements, and next, number of employees. So if you have filed any return yet, or if you have checked the portal, so the portal is asking for average number of employees that entity have. So you should have number of employees with you, and then the amount of transactions with related or connected parties, which will be covered in detail by my colleague Ashish. This information should be with you. And then from documentation part, so if you have opted for transition relief, you should have revaluation reports. If audit is required to you from angle of tax, and audit is required to the entities which have more than 50 million dirhams of revenue, or which entities have opted for qualifying free zone person relief. So if you are satisfying these two conditions, just audit your books and accounts. And documentation needed to any relief that you want to opt. So in case you want to opt any relief, just maintain the documentation, the supporting documentation that is needed for that relief. That these all the documents that you have to prepare with you. And now, we got the tax liability, we gathered all the information, we gathered all the documentation, and now question arises: when to file the tax returns? So the due date for the tax returns will be 9 months from end of your financial year. For say the financial year from Jan for the taxable person which have closed the financials on 31st December, the due date will be 30th September 2024, which is 9 months from end of their financial year. So you in this thing we would like to suggest you that don't wait for 30th September to come. Just prepare everything as soon as you can and file the return, because UAE is the region, in this region that there are a lot of penalties, and they don't believe in waiving of the penalties. So for delaying any return, there can be a penalty. There will be a penalty. So just file the return as soon as you can and prepare for the return as soon as you can. This was all for return filing, registrations, and everything compliance, or everything that we have to take decisions on. All this was all, and now there is another critical aspect called transfer pricing. So that will be covered by my friend Ashish. Ashish, over to you for the transfer pricing. Thank you.
Just before Ashish begins, thanks Kushal for such a comprehensive and detailed corporate tax summary which you have given to us. It just took us through the entire journey. It took me back to 2022 when the law was released till date when we are just approaching the first return filing season. So before Ashish takes you all through the transfer pricing compliances, I just want to quickly summarize what all Kushal has mentioned. So primarily, there are two sets of compliances which are to be done. One is registration, another is corporate tax filing, and there are several other compliances which are to be done so that we make sure we comply with these two major compliances. For registrations, almost the due dates have ended for the entities which were established before March 2024, which were established recently. For them, the registration was linked to the license date, and for most of the entities, the registration dates have ended. In case you all have not filed your registration, there is still an option to get a penalty waiver, but that will again depend on how strong your case is. So then we look forward to the next compliance, which is the return filing, which for most of y'all would be due in 30th September. And to file the return of income, it is very important that we make sure that whatever elections are to be done or whatever reliefs are to be claimed, we make sure that we don't wait till the end moment to make a decision on them. Rather, before we finalize our audits, we make sure that we have made up our mind on the elections and reliefs so that we can create an appropriate provision in the books of accounts to reflect the correct tax liability. So that is another critical element which we all should keep in mind. The hot and buzzing topic for 2024 was free zones. So, in case you are qualified for 2024 as a free zone, then yes, go for it. Make ready. You have documents in place which proves substance, which proves that what is the segregation between your qualifying income, non-qualifying income, which proves all the tests that you have sailed through during the year for being a qualifying free zone. In case 2024 was the year where you did not meet any test, then you need not prepare for 2025 because you're automatically out of the regime for the next 4 years. In next 4 years, excluding 2024, that you'll out of the regime for total number of set for 5 years. So yes, all these small things will have to be kept in mind. Your auditors, consultants, all of them will have to be looped together so that a comprehensive corporate tax policy can come out of whatever has been discussed and been put in place. With this, I think corporate tax is sorted. Now comes very difficult part, which is transfer pricing, and I'll hand over to Ashish for that.
Okay. Thank you, Kinjal, and thanks, Kusha, for covering the corporate tax bit so in such a detailed manner. I mean, as Kinjal rightly mentioned, we started off from 2022, and you took us from the entire journey of corporate tax. And now comes the elephant in the room, transfer pricing. Today's seminar about transfer pricing is going to be about all the misconceptions that we usually see when we talk about transfer pricing with the business owners, and what are the steps which we need to take, because as Kinjal had mentioned earlier that the first tax period is over now and we are heading towards the first return filing season, and it is a high time now that we actually understand the situation we are put in and address it, because in this part of the world most of the business owners would have at least two or more entities to conduct their business. It is very rare that one entity is conducting all the business activities of the group, correct? So when that happens, there are transactions entered into between these entities, then the business owners have entered into the transactions with their companies, which gives rise to a transfer pricing compliance. And there are so many transactions which one might feel like it is not covered under transfer pricing spectrum, but it is actually when you really look into it. So the scope of UAE transfer pricing rules is really wide. Like in many mature jurisdictions, you will find that transfer pricing is only applicable when an international transaction has been taken place by the entity. However, in UAE, it is different. Even under domestic transactions, transfer pricing is applicable, and people have to comply with the arm's length principle in the domestic transactions as well. It is the scope of UA transfer pricing regulations is so wide that even if two mainland entities are entering into a transaction, both of them are paying taxes at 9%. Even after that, they have to comply with the transfer pricing regulations and comply with the arm's length principle. So this is the first thing that people need to understand, that if you think that there are no related party transactions, look again. If you think there are no connected persons transaction, then look again, because from my experience, I believe that you will at least find a one or two transactions in your financials out of it. Karishma, can we go to the next slide, please? So the first step, like after breaking the misconception of having no related party transactions, the first step which you need to take is identify the related parties you have. In the definition of related party, it can be bifurcated in two ways: related party of your company and related party of the owners of the company. For natural persons, the related party definition has given a very wide scope. It covers up to 4 degree of kinship or affiliation by way of adoption or guardianship as well. What kinship really is? It is your blood, any relative, blood relative, anyone connected to you by blood. So when it goes to fourth degree of kinship, your entire family gets covered up. There is no way you'll think of someone in your family and believe that okay, I'll just incorporate a company in their name and start undertaking transactions with them, and I'll be outside the purview of transfer pricing, because that it is very rare to happen that. And the other leg of related party definition is the related parties of the companies. Karishma, can we move to the next slide? The earlier one. There's one slide before this for companies, yes. So for juridical persons, if any natural person or a juridical person is having 50% or more ownership in them, then that natural person or the juridical person is a related party in that company. And it is just not limited to ownership. Even if they exercise control or significant influence directly or indirectly, then also it may become a related party. The transfer pricing guide released by the FTA is so detailed, and they have given examples about what would tantamount to control or significant influence, and how even without 0% of ownership, two entities can become related parties because of this condition. And so these are the things which needs to be evaluated now. We need to identify the related party. One might just consider that since there is no ownership linked to these two entities, they cannot be a related party, which is not correct in the case. And this is why identification of related party is the first and the most important step one needs to take towards their journey of TP compliance. Can we go to the next slide? Once we have identified the related parties of the business, the second thing we need to identify is connected persons. Connected persons can be bifurcated into three classes. One is the owners of the business, second is the directors of the business, and third is partners of the business. If you fall, or if there is any person who falls under this three categories, and they are getting any payment or benefit from the company, and not just them, if their related parties are getting any payment or benefit from the company, then it will fall under the purview of connected persons, and it all these payments need to be at arm's length price. So once you identify your related parties, your connected persons, you move to the next step. Karishma, can we go to the next slide? Once you identify your related parties and connected persons, and you identify the transaction which is happening between them, then you find the arm's length price for that transaction. The transfer pricing guide as well as the OECD guidelines has prescribed five methods, and the sixth one is other method, which can only be applied when the first five methods are not being applicable to any case, which is very rare. However, there are circumstances in which other method can be used, and a combination of these methods can also be used. Now, the methods which are mentioned here are not very relevant for a business owner, because usually this would be taken care by your external consultants, and it is a headache for them and not for you. So but just to mention them, there is CUP, there is RPM, there is TNMM, there is cost plus method, and there is PSM. Most of the transactions out of carried on by a business would be either benchmarked using CUP method or TNMM method. These are the most relevant methods, and they are easy to operate, and they provide very accurate results. And because of that, they are very relevant when it comes to benchmarking of a transaction. Can we move to the next slide? Once you have identified your related parties, you have identified the transaction that you're doing with them, then you have applied a transfer pricing method to benchmark and to find the arm's length price. Then the next step that comes to the picture is transfer pricing documentation. This is the most important part of your transfer pricing exercise, because if there is any if this bit of the exercise is not done to its best possible extent, like let's say that there is some thing you have missed to document, then it would the entire transfer pricing exercise would can be jeopardized because of that. So when you prepare the documentation, it needs to be thorough, it needs to be detailed, everything needs to be included into that. Transfer pricing documentation can be divided into two parts, basis the revenue threshold, which the law has prescribed. The revenue threshold is if you are a part of an M&A group which has a consolidated revenue of 3.15 billion or more, or if you're not part of a M&A group, but you are as a single taxable person, your turnover is exceeding 200 million dirhams, then a different set of documentation requirements would apply to you. And if you don't exceed these two thresholds, then a different set of documentation requirement would apply to you. Now, when you exceed the revenue threshold, things you need to document are TP disclosure form, a local file, master file, and CBCR. However, CBCR is only applicable for M&A group, which is exceeding the revenue threshold. It is not applicable for single individual taxable person with revenue exceeding 200 million. For every entity which does not surpass this turnover threshold, we get a lot of responses from clients where they are like, we are not crossing the 200 million threshold, why should we document, why should we maintain the entire documentation? It is because even though you are not crossing the threshold, you are required to file the TP disclosure form. And if FTA ever request from you your TP documentation, then you have to provide it within 30 days. Every single piece of evidence you can document, you have to document it and provide it to them. uh, can we go to the next slide? Now, one after we're clear about the documentation part, there is another a misconception in the general public that the thresholds which were recently announced in the city written guide of 40 million, 4 million, that if only if you cross that threshold, only then you need to maintain the documentation, which is also not the case. The documentation needs to be maintained even if there is just a transaction of 1 dirham between a related party. These are the disclosure requirements while filing your TP disclosure form along with your city return. And the disclosure requirements are, first thing you ask is the aggregate value of all your related party transaction exceeding 40 million dirhams? If the answer to this question is yes, then you report all the transactions that exceeds the value of 4 million dirham. But this is also a tricky part. The aggregate value of 4 million dirham needs to be seen per category and not per related party. So let's say if I have one related party and I have sold goods worth 3 million dirhams to that related party. On the other hand, I've also given them consultancy services of 2 million dirhams. So I am crossing the 5 million dirhams threshold with that related party. But if you bifurcate it according to the categories, these categories are provided on the portal itself. And if you bifurcate it, then I have not crossed the 4 million limit. Then I don't need to disclose that related party in my city return. But had I sold the goods worth 5 million dirhams, then I would have been obligated to disclose the entire transaction of 5 million dirham sale of good with them, the benchmarking report, the method which I have used to determine the arm's length price, the arm's length price which was calculated in the exercise, and every single detail. The one relief which they have provided is if there are dividends being distributed to related parties, then they do not need to be disclosed in the schedule, which is fair as well because the dividend only comes into the picture after the taxes are being paid. So it's not a relief after all. CBCR requirement, I already mentioned about that. Contents of documentation is very simple. Everything you can document, your document, every email, every policy, every intercompany agreement you have entered into, you have to document those things and keep it with you for 7 years. One exemption which is provided for the maintenance of a master file is that if you are a MNE which is headquartered in UAE and does not have any exposure or presence in other jurisdictions outside UAE, then you do not need to maintain a master file. Only a local file would be suffice for such groups, and local file will already cover all the transactions that are happened in the UAE. And since there is no presence outside the UAE, master file is not required here. Can we move to the next slide? This is a snapshot from the corporate tax return, which is on the portal. It asks you two simple questions. Are there any transactions with a related party or are there any transactions with connected persons? If you say select no here, your life is very simple. As soon as you select yes, it opens a series of questions for you to answer. Can we go to the next slide? A series of questions, as you can see, the name of the related party, tax residence, transaction type, gross income, everything needs to be mentioned here. Even for connected persons, that is the case, the name of the connected person, why the benefit or payment was provided, their TRN, every single detail they would ask. So this is, if you take up this exercise during September 2025 at the time of your written filing, then you'll surely miss the deadline for the same. Local file and master file is also required to be attached with the return. So these things need to be prepared in time because as I always say, a stitch in time would save nine. Can we go to the next slide? Now, as Kushal already mentioned that in this part of the region, penalties are heavy, and because of that, the cost of non-compliance will always be higher than the cost of compliance. And we should always consider that and be compliant from day one, so that we don't have to burn our midnight fuel at the end of September when the return deadline is nearby and these exercises are still yet to be done. Can we go to the next slide? So this brings me to the last slide of the day. First, you identify your related party transactions as soon as possible. Start benchmarking them. Prepare your TP documentation. File TP disclosure forms. Submit the files. Maintain the records for 7 years. And as you can see, TP documentation, disclosure form. They've given you time till the end of your till the time of your filing of your corporate tax return. But if you really think about it, you only have time till the your audit is concluded. Because of that, we need to be quick. We need to close these things before the audit is concluded, because going back to those financial statements and making amendments in them is a task in itself. So it's better to be compliant from day one than to go back and make adjustments later on. Thank you. I believe the presentation concludes here. If you have any question, feel free to ask. Me and the entire team is here to answer.
Thank you, Ashish, for taking us through the elephant in the room. Just to again summarize what Ashish said, one of the key myths which he cleared about transfer pricing is that it is not the case that only when you have crossed 40 million, or you have crossed 4 million, or you have crossed zero point 0.5 million, you start need to working towards it. You should have already started working towards it, but if you have not, at least you should do it before the audit, or if not even before the audit, before the return filing, so that if your books are not adjusted, at least your return can be adjusted for any sort of transfer pricing adjustment which is required to be made, um, for an appropriate disclosure. This is again very important from the entities who are claiming the free zone tax relief, because complying with transfer pricing is one of the conditions there to be able to claim a free zone tax benefit of 0%. And therefore, the urge is to get this done as soon as possible. With this, I'll just move to the questions, if any. I think we've answered most of them over the chat, but I think there's an attendee which is asking whether in India there is an IAS 116, which can help you on depreciation on ROU asset and interest on lease liability is allowed so in UAE. Also, do we disallow both and allow only the actual rent paid, or simply say it that as per IFRS, so depreciation and interest both are allowed? What are your views on that? So, uh, unknowingly, the life of the tax accountants have been made very clear, have been made very simple by the FTA, because what they've said is you trust your wise auditors for certain treatments to be followed in the financial statements, and you can rely on them, unless you are of course claiming an expenditure which is not in a business nature, or you are claiming an expenditure which is specifically disallowed, like something sort of entertainment expense. Except those specific expenses which are there, you can rely on your auditor's judgment used in the financial statements. And therefore, to answer your question, you can simply rely on the IFRS for the claim of depreciation and interest both. Interest, just to make sure, interest, there are specific disallowance rules which are there, which trigger when your interest crosses 12 million. So, but this again is interest on lease liability, so that would not apply. So yes, you can rely on your IFRS for that, on your books of accounts for that. How do we benchmark remuneration paid to a connected person? This has been the most trending question in UAE, because there is no specific method which is there in the transfer pricing guide or any other rules which have come up, and therefore the entire industry has come together and has decided a method which everyone would unanimously follow, which is necessary to document the profile of the person, of the connected person, and then to get the quotes as to what would be the value of service which they are providing, and then to benchmark it. Ashish, would you like to add something, since I can see you on the camera?
Yeah, I think you summarized it pretty well. And as you mentioned, the guidance is not provided in the law.
Hmm.
So people are really experimenting with the methods which can be used. Most suitable seems to be getting the quotes from HR consultancies. In some cases, we have also seen TNMM being used as a supporting method with this other method of HR
Right,
quotes. And
right.
if And as long as everything is documented and put in place with facts that are available at the time being, I think that would suffice to benchmark a connected person remuneration.
Absolutely. There's one more question which has come on TP only. If company benefits from small relief, is it excluded from TP document obligation? So yes, if you are claiming small business reliefs, there is a specific guidance which is available, which does not particularly exclude you from all the transfer pricing obligations. But what is mentioned that okay, all your transactions are still required to be conducted at arm's length price. But yes, the documentation requirements are slightly relaxed. Also, to our understanding, when we had checked the form earlier, the TP disclosure form only opened for the turnover which was above 50 million, but the CT return updates day in and day out. So we don't know if that update still is there, given that there are uh, specific thresholds which have been released for disclosing the transfer pricing related party transactions. So yes, the compliances are relaxed in terms of TP documentation obligation, but there's a specific guideline that okay, you have to make sure that all the transactions are at arm's length. Any other questions? Transactions between a company and its individual shareholder who's a natural person, such as payment of interest on loan or remuneration, would be categorized under Article 35, related parties, or under Article 36, payment to connected person. So this would be categorized. Your shareholder, your individual shareholder, would be the owner of your company and the sole owner of your company, and that person can be very well categorized as a connected person to the company, and therefore this will fall under Article 36 and will have to be benchmarked accordingly. When we check the Emara portal, we cannot see the CT return has been unlocked. Any idea by which date it will open to submit the return? No, we do not have an answer as to when will it open for submission of the return. But yes, even we are expecting that it comes soon so that everything is not backlogged on 30th September.
To add on this question, even if you are not able to see the return on the portal, and if your deadline due date is approaching, what you can do is submit a request by sharing the screenshots to the on the portal itself and ask them for any solution. We had this one scenario where the same thing happened and the return was due in 3 days. And when we contacted on them on Emirate X portal, the next day the return was visible and we were able to file it. So I think that would help.
Amazing. Thank you for sharing this practical aspect, Ashish. With this, I think we have covered all the questions and we are at the end of the time as well. So, what we can quickly do is we do have a group where we regularly share updates on corporate tax matters, and the name is very well called Local to Global. So, it does not only cover UAE corporate tax, but it covers global tax rules. Anywhere, anything heated up in the world in relation to tax, we share it in our tax world. So I'll just share that link in the chat box and would request all of y'all who are not a part of the community to be a part of our community. We would love to have you there. We would love everyone to join and be a part of our community. And with this, we end the webinar. Wishing you all again a very happy and a very compliant 2025 ahead. May none of us have any penalties for missing any deadlines. And yes, wishing you the best of health. Thank you.